Well, good morning, everyone. Welcome to Investing Master Series. My name is Barbara Armstrong. I am filling in for the fabulous James Boyd today. He is in Kentucky with family, and I believe he will be back tomorrow. If you are not following us on X, you are missing out, my friends. At James Boyd CS, at Barb Armstrong CS, and we have Connie Hill with us in the chat. She's an excellent coach and a friend and understands everything we're talking about today in spades. So if you have any questions, don't hesitate to type them into the chat. If you are watching this in the archives, as the majority of people do, you can type your questions into the comments down below, and I will respond to those generally within 24 hours. So Connie Hill CS, she posts a lot of great stuff on X as well. So Investing Master Series, just like, what is that anyway? And what do we talk about? Well, what we're working on in this class, and this is not an introductory level class, it's an intermediate to advanced level class. So we're working on mastering different skills, right? Investing mastery. And I think one of the things you have to have is a goal. You have to know why you're doing this. And, it may be because you already have a giant heap that you're trying to protect, or maybe you have a not so giant heap, but you want to protect that, like whatever it is. Maybe your goal is to grow your account long term. You don't need the money now. Maybe your goal is to generate a monthly income. And so we're going to talk about generating weekly or monthly income today using a strategy called a buy right covered call. And one of the reasons that this came up, well, I'll share that with you in a minute. Just before we get into things, though, James is gone today, and I highly doubt he will watch this. So I wanted to share with you because, as you know, if you come all the time, James always teases me about how I say flag, and we talk about trading patterns with flags. And he says I say fleeg. I do not say fleeg. It's flag like bag, like hag, like brag. But I have ordered dozens of these. And when James comes back, he will wake up one day and yes, he will find flags all over his lawn, but it does lose a little je ne sais quoi if I do it when he's out of town. So I'm going to wait, and there will be pictures and more ribbing to come. So they haven't been planted yet, and there's a little assembly required, but so stay tuned for more, and shh, don't tell. Okay, so after that little bit of friendly ribbing between us, stay tuned for more on that. So, but just know, this strategy we're talking about today includes both stocks and an option component, and know that options can carry a high level of risk and aren't suitable for all investors. You also have to apply for option trading privileges with Schwab. So if you have been honing your skills in paper money, know that, when you go to your live account, if you try and put the trade in and it doesn't work, this might be why, you've got to apply. We do all our examples on the paper money software on the Thinkorswim desktop platform, and it is a great place to learn. One of the differences, though, is that you will never be called out early in paper money, and this can happen in a live account. And so we're going to talk about, why this might be a thing. And why it's not necessarily a bad thing with the strategy we're talking about now, but with some option strategies, it can kind of throw you for a loop. So you just want to be aware of that. Also know with stop orders, and I'm going to show you how to put a stop order in today, that you're not necessarily going to get out at the price you requested. If the stock were to gap down, it could work out not as quite the way you expected. Okay, so we need to be aware of that also. And I just want to acknowledge all the people who are in this class that help bring it to life. So to Dragon Rider and Jim and CU and Janelle and Josh and Fayez and Wiley and Trade and Grow. I love some of your handles, guys. And See Me Go, like, It's so clever. And BJ and Richard and, the first one's in Sia and Paul and Michelle and Life in the Fast Lane and Kevin and Gary. Thanks for being here. And I love all the pink hands and the hearts. And, I tend to use all the wacky smiley faces myself, but, it really helps add some personality to our chat. And yeah, appreciate you doing that. So together we are stronger, right? Okay, so we're going to have a quick look at what's going on in the market. And because Kevin Horner typically, 4 days a week, does a really great class at the market open at 9:30 Eastern, I'm spending very little time on this today so that we can spend more time on this strategy and on placing a bunch of example trades. Okay? Okay, so that's what we're up to. So let's get out to the platform. And if you want an in-depth market analysis, go and look at Kevin's presentation at 7:30 this morning. Well, actually, it's Tuesday, so today was futures. Today is the one day that he doesn't do that, so you can look at yesterday's recording. But the S&P 500 hit a new all-time high today. It's now down just a smidge, like not even 0.2%. But, this market, this is a 3-month chart. But if we go to a year-to-date chart, this index is up, 11.8% year-to-date. Hard to characterize from April 7th on this trend as anything other than bullish. When we look at our NASDAQ, which is our tech-heavy index, no financials in this index, it too has hit an all-time high today. Okay, so bullish. So what about the Russell? This is our small caps, 2,000 of the biggest of the small boys. Well, this is, 4 days ago or 3 days ago, this hit a year-to-date high. It's not quite at an all-time high, but it's within a stone's throw of it. And certainly, we're up cruising near the highs for the year. And how about the Dow? Okay. Average, this is my red line. We're above the 10. And even though we've had a little bit of a pullback, there are many that would look at that and say what? Bull flag. Potential bull flag. It's not complete, but it's a potential, like BJ said, it's a potential setup. But we do have a red candle, so we want to keep an eye. Nicely said, BJ. Okay, now we're going to come to the last one we're going to look at is the VIX. And, it's a little elevated today, but, the Fed is going to come out and are they cutting rates or are they not? Word on the street is we're expecting a rate cut. And if we have a rate cut for all these growth companies that are really driving the market, might that not, be a good thing? So this is, how we're, but there's always a little more hesitation coming into these announcements. And that's why I think we're seeing this up. It's 46 points, so it's not like it's soaring or anything, but, this is what we're looking at. Okay. Okay. So, and then if we wanted to look at sectors, you can just come down here to the sector indices. This is a public watch list. And if you go to my X, because I don't know what S&P 510 is, so I've added description here. But I've added these two columns, a 3-month column and a 4-week column. Communications has been leading the pack, followed by technology and consumer discretionary. So pretty darn bullish. Again, that's over the last 3 months. And if we click on these, so sorry, let me just bring these, communications hitting a new high today. Technology, new high today. Is there a theme going on here? Bullish, right? Even our financials, not quite as extraordinary, but this one hit a new high within the last week and it's still hanging out. It's in the hood, And again, last month, communications consumer discretionary, and energy seems to be making a bit of a comeback. Now, not quite the exciting chart, and maybe, I can just shake my Etch-a-Sketch and get rid of these previous drawings. But, heading in, an upward direction. So maybe there are some energy stocks that, one might want to have a peek at. And then some might say, well, if I'm playing I Spy with my little eye, I see a big fat pennant and it's not quite broken out yet. Depends on how you draw it. Like if you drew it like this, and this is where, because this has only one point of contact, if we came in and kind of drew it like this, you'd say like, yeah, Barb, you kind of missed it there. Like it's already broken out. And this is where the art of technical analysis comes in, right? Because I may look at it one way and you may look at it another. And there's no right or wrong answer particularly. It's all in how we interpret it. It's like looking at a piece of art. It may mean one thing to me and, something else to another person looking at it. It's how we respond. Okay. Having said that, there are some general things when it comes to technical analysis. And if you're newer to all of this stuff, I do teach getting started with technical analysis. Today, we're going to talk about divergences. And next week, I'm going to talk about the 7 things I wish I'd known when I started trading. So you may want to, check that out. Okay, so the first one we're going to look at today is O'Reilly. So, today is partially sponsored by the letter O. I was just visiting my grandson a week or so ago, and, I've always been a big fan of Sesame Street and the Muppets. And so I came back and it's kind of top of mind. But O'Reilly just had a 15-for-1 split. Like this used to be such an expensive stock, and it hasn't changed its value. It's just that, now, we wouldn't have been able to perhaps do the kind of trade we're talking about, prior to this split, depending on your account size. Yeah. So, when we look at this, what do we see? Well, we see a stock that's up 35% year to date. So it's beating all of the indexes, very bullish. If you're not familiar with O'Reilly, I actually went in one. It was a hot tub driven purchase that I went in for. But it actually usually right under here would say what this, what sector this company is in. I believe it would be considered to be consumer discretionary, although I would think auto parts are more of a staple. But, it is an auto part company. It looks like many of the analysts are pretty bullish on it. But, it's not unusual to have one outlier. And so who's right? Well, you can read the reports and make your own decision, but this company was founded in 1957, so it's been around for a hot minute. And if you wanted to look at some of the fundamentals, you can certainly come down here and have a peek. We've seen, their earnings per share has been kind of steadily increasing over the last 5 years, and so have sales. But it's, just because this has happened over the last 5 years doesn't mean it's going to happen over the next 5. And the strategy we're going to talk about today is actually, we're not looking to enter a long-term relationship here. This is what I call a dating strategy. And I'm going to be in Dallas this weekend at our in-person event. This is shaping up to be the biggest live event we've ever done. So I hope you come if you're in the Dallas area. We'll have the coffee on, we'll provide breakfast, we'll provide lunch, we'll provide a great reception at the end of the day. And it's a chance for you to link arms with your fellow traders and spend a day with all of us. We're flying people in literally from all over the country for this event. And we go from what's happening in world markets to discussing individual stock and kind of everything in between. So I think, Janelle, you're going to be there. I can't wait to meet you. And there are several others that will be there, that are regular attendees. So I encourage you, come up and introduce yourself. Like I will be there. Kevin Hinks will be there from the network. Joe Mazzola, who's a frequent network contributor, will be there. Kevin Horner, Ben Watson is going to be there, like a cast of thousands. So, a lot of the network people as well. Anyway, the strategy we're going to talk about today, when I first heard about buy right covered calls, I thought it was the dumbest thing I'd ever heard of, because to me, buying a stock is pretty bullish, and selling a covered call, to me, at that time in my journey in the world of trading, meant you thought the stock wasn't going to go anywhere. But the idea, and it was actually Cameron May, because I said, this is the dumbest thing I've ever heard of. Like, who would want to buy a stock and at the same time sell a covered call? And the idea is, he said, well, you could make a return potentially, of maybe 2 to 8% in 15 to 50 days. And I went, okay, I'm listening. And the idea is that you sell a covered call with the intention, if the stock is uptrending, which this is, of it getting run over, and your goal is to get called out. The goal is to get called out. Now, what if you don't get called out? What if it blows through and then comes back down, and we get to expiration and it's just below? Well, we can, let this expire worthless. We could buy it back. Like, maybe we got $2 for the covered call when we sold it. Maybe we buy it back for 20 cents. Okay. And then what? Like, if it's, let's say, we buy it at 106 and we sell the 110 call, and at expiration, my tool is, say it's at 108. So I get to keep the $2. Now the stock's trading at 108. So I could just sell it. I've made a bit of money, and, we're a happy camper. Or maybe the next time I sell the 112. So in our trading a smaller account, we did this with, I think it was Celsius, CELH. And the first covered call we sold at like $40. Sorry, my drawing tool is not playing nicely. We sold the first one at $40, and then the next one we sold at 42. And then I was gone on the Barb 2.0 project, and the last one we sold expired, and then the stock gapped up, and the last one we sold was either for 60 or 65. So, it does, and that is, fairly, I said there was a bit of benign neglect that worked in our favor on that one, but this is the idea. And I met someone, and we're going to be back in Chicago in the first weekend in October for another market drive. But I met someone at that event, and, I asked him how it was going, and he said, well, what I'm really looking for is an income generating strategy. And I said, well, what trading strategies do you like? And he said, well, I really like doing those buy right covered calls, but my problem is I can't protect myself to the downside. And I said, sure you can. And he said, well, how can I put a stop loss in to protect the stock when I've sold a covered call? I could end up with a naked call. And it's like, well, I'll show you how to do that. And so I asked him how much he wanted to make. And I have no idea whether he was being realistic. I don't know what his account size was, but his goal was to make $100,000 a year in income by trading and using this strategy. And I said, well, that's, 8 times 12 is 96. So if you aim for 8,000 a month, then that's 2,000 a week. Well, if you just say 2,000 a week times 52, that's going to get you to 100,000, right? So assuming that you don't take any weeks off. And so I said, well, here, let's go through an example, just an example, and I'll show you how to put an exit in so that you're defining your risk. And you have to know that not every trade is going to go your way. There are going to be trades that do not work out, and that's just part of trading. Okay. So, but if we look at O'Reilly and we say, okay, this has been uptrending, had a 2-day pullback. Today, it appears to be bouncing off this 10-day moving average. So if we look at this and say, if we bought it for 106.53, this recent high was 108. What if we expect the trend to continue? I wonder if we could get enough premium if we came out to October to sell the 110. Now, this is not a stock with much volatility. Look at this. Talk about steady Eddie. But what it's saying, this 731 in brackets, this is the expected one standard deviation move. So it could go up by up to 731 is what they're saying. Now, not always right, or down by 731. But, oh, this is weird. Why have we got this 110.67? That's just a weird, it's probably because of the split, because of the 15-to-1 split. So, but if we get 295 to 310 for this option, oh, this is November. I was thinking it didn't look like that earlier. Okay, so here's the 110. And let me just come back. We're going to bring this back to my basics with probability in the money. So if we get 140 to 155, and we've got 829 contracts, our rule of thumb is we want, this stock to trade at least 1 million shares a day. We want there to be 20 times or more the number of contracts that we want to trade. And we want there to be a tight bid-ask spread. We want it to be less than 10%. And it's 15 cents, so it's about spot on. This example account has about $500,000 in it. Our max position size as a rule of thumb, and it's, would be 25,000. So at 110, we could do 2 contracts. Well, let's just do the analysis. It's like, well, is the juice worth the squeeze? So we call it a buy right covered call. On Thinkorswim, we call it buying covered stock. So we're paying $105.03 to get in. What's the most we can make if we're called out? Well, let's just round it and call it $5. It's 499. Well, okay, let's call it 500. Like if we come to confirm and send, it says the most we can make is 501. If O'Reilly went to 0 by October 17th, we'd be out $10,499. So we're going to put an exit in, but at 105, if we can make 5, that's about 5%. It's 4% and change, right? Because we're just going to take that $5 we can make and divide it by the 105 we're risking per share. So that's 4.76 or 4.8%. And you might say, well, that beats a poke in the eye with a sharp stick. When you're considering this is a dating strategy, we're in it for how long? We're in it for 31 days max. And then we either are called out or we buy back the call or we exit the position. Now, how and where would we put our exit in? Well, we might say, hey, this 10-day moving average has been acting as support. So if I looked at yesterday's low, 105.68, or we could come back to the 30-day moving average or to this support level. I mean, you can pick whatever support level you want, but if we said, hey, if it goes down by more than 3%, I'm going to take that 105.68, and I'm just going to use my little calculator here. 105.68 times 0.97. That's 102.50. So that's below this 30-day moving average. So if it goes below 102.50, we'd like to close out the position. Okay. So that's going to be our stop, 102.50. So how much are we risking then? Well, we don't know what we're going to have to pay necessarily to buy back the call, but if we're in for 105 and we're out at 102.50, we're risking about $250. And if we're saying, hey, our max risk on this is, $2,500, that's half of 1% of our account value or thereabouts, we could do 2 contracts. So the most we can make is 1,000. But if your goal is to make, let's say it was to make, 2,000 a week, this would fulfill, half of your week. This could be one trade. Now you could end up losing. So maybe what you want to aim for then is 2,500 a week so that you have a little extra. And then you put that extra aside for the weeks when you end up in the hole, when you might end up losing money. overall. So we're looking at buying the stock at the current price, which is 106.47. We're selling a covered call, which brings the net price down to 105. We're going to change our single order to first trigger sequence. And here's how we put in our exit. We're going to create an opposite order. We're going to make it a market order that's good till canceled. And then we click on that disappearing, reappearing sprocket, and we're going to say, hey, if O'Reilly goes below 102.50, not going in the right direction, I want to admit it quickly if this isn't going my way. So if it's less than 102.50, get me out. And then we're going to put this in, our buy right covered call group. Okay. Just let me look at the chat. Yes, I was on November. We're buying the stock at the current price. We might end up selling. Yep, I think we got that. Somebody like that goal, 2,000 a week. Yeah. Yeah, somebody said it's Sharon, and I thank you, Sharon. I've met Sharon, had the privilege of meeting Sharon in New York, in Anaheim. Yeah, and the events are awesome. I loved attending them as a client, and I love them just as much getting to go as a as a coach. And Jay was at the event in DC last weekend. A little bittersweet. I wish I had been there, but yeah. Okay, so that's O'Reilly. Now, as part of, I said partially sponsored by the letter O, let's say you have deeper pockets and you've got, an even bigger account. And so you might say, well, this is 306, that's 30,000. But Oracle, when we come to the trade tab, and again, we had this stock gap up on earnings, pulled back, and what do we now have? We now have a close above the high of the low day. It looks like this uptrend might continue. And if you say, well, I wouldn't mind, continuing to own this, stock anyway, and this ATR tells us how much the stock moves in an average day. It was moving about $7.30. And then after the gap, this number skewed up to about 15, but it'll probably plateau somewhere, maybe in between these two. But, when we're looking at this and saying, okay, 305, this recent high was 345, could we sell the 340 call and get enough for it to be worth our while? Well, look at the volatility on this baby. 53%. What does that mean? Well, it means we're likely to get a higher premium on these options. So at 760 to 775, we've got thousands of contracts, 27 million contracts traded already today, almost 28. And this is a $300 stock. So if we come and look at this and we said, well, it's trending. If we get called out at 340, we're up $35 a share. So we're up more than 10%. Plus, someone will have paid us $7.50-ish to, buy our stock from us. Now, the probability of being called out, of it being in the money at expiration, is currently about 23%. But there's a 47% chance it'll go up and at least kiss that number between now and October 17th. If we come down to the 330, we'd receive $10 less a share, but we'd get paid $2.40 more on the option. And then if it's not at 330, and you got about a 70% chance, that it isn't at or above 330. Yeah. So anyway, we're going to go with the 340. And the thinking that a trader might have is like, hey, if I'm not called out in this, if I think it's going to continue to trend up, I get to keep this $750. That puts a good dent in my $2,000 a week target. And then I can wash, rinse, repeat, and sell it again. I can let it expire worthless, and following the expiration, I can sell another one, or I can roll it, which is really just buying back this one and then maybe selling one in November. And let's say the stock's at 330, then maybe I go out and sell the 350 instead of the 340. And if I'm called out, well, I've just made a really nice return because I'm up, and I'm just rounding here to make it easier for me to do the math. Like, we're up $41 or $42. That's 40, that's 2 weeks worth of our goal, at 4,200, and I'm dividing that by the 300, well, it's $298 a share. So, that would be a 14% return. But the probability of that happening with where the stock is currently trading is about 23% of us being in the money at expiration, a 47% chance of it coming up to this level and kissing it between now and September 7th or October 17th. And so this is 5,000 above this accounts. Now, some people on a quarterly basis will redo their numbers. So they might say, hey, we're at 523,000 and we're willing to put, 5% in any one position. So, we started at 25,000. We're now at 26,150, and we're a little bit above that, but we're okay with that. Now, where would we put our stop? Well, we might say, hey, here's, kind of a recent low. And let me just change this because I've set my drawing tool up. The default, it gives me that price. So 292.67-ish. Like when I look at this was 291.75. So if I say, okay, I'm going to go 3% below that, 291.75 times 0.97. And some people might prefer to do 2%. Some might give it a bigger bandwidth and do 4 or 5. But 282.99 would be our exit. And so that's about $10 below this level, because this is at 292. So if we come to the trade tab at 282, we're risking about $1,500. So we're only going to do one contract. We're okay with risking up to 2,500. That's half of 1% of the original account value. So again, we're going to create an opposite order. We're making it a market order because we don't know what we're going to have to pay to buy back the call. We just have a degree of, our expectation is that it would likely be less than what we received when we bought it, because the stock will have fallen in value. So we're going to make this 282.99. 282.99. Okay, confirm and send. So this position now, this does not recognize that there's a stop in place, this max loss. But we're saying, hey, if Oracle goes below 282.99, it's right now trading at 305. So, it's given it what, 20 some dollars, $23 worth of wiggle room. And we're buying 100 shares of stock and selling the 340 covered call. And so we're going to put that in our buy right covered call group. And you want to read this, and it's saying, and I've said this before, with stop orders, no guarantee that we're going to get out at the price we're asking for. And, if the markets, were to be really wide, in other words, if the market started to fall dramatically, this is just saying that they will work to get you the best price they can. Okay, so we're going to send that in. Okay, so those are our letter O. How about we go over to the banking center? Because you may say, okay, Barb, but both of these stocks were kind of expensive. Yeah, so Andrew is saying, does the opposite order also buy back the call we sold? Absolutely it does, because otherwise you'd have a naked call with unlimited risk. Yeah. So let's come and look at Bank of America. And this is a $50 stock. So, you might say like, hey, you have a trading a smaller account. What about those of us who don't have like a $500,000 account or $1 million account? And I hear you. And also, like, what if this stock isn't like flying to the moon? Okay, but you know what? It's up 15% year to date. So, that's last time I checked, beating the S&P, which is up 12. Like, so it's, doing not too badly, but it's been kind of going a wee bit sideways. And but remember, what's our goal? Our goal is to earn a monthly income. And so if we come out to October and we say, okay, this is at 50.47, what if it just keeps going sideways? Well, what if we sold, say, the 52? And if we come out to October, it's like, well, there isn't a 52, but there's a 52.50. And again, 8 million contracts, lots of open interest. That's the number of contracts that were on the books when we got up today, almost 20,000. Like, so very heavily traded, 2-cent bid-ask spread, 30% probability of it being in the money. You're saying 83 cents, like that is like not a whole lot. But if the stock went up by $2, that's 4% on a $50 stock. And then if we get another, like $1 would be 2% on 50. So this is what, like 1.5%. So if we look at this and we say, okay, so if we bought covered stock on this and we could make 250 plus another 36 cents. So if we could make 286 on an investment of 49.64, that's 5.76%. Call it 5.8. Like again, like, good work if you can get it. It's an old expression, or like I like to say, beats a poke in the eye with a sharp stick. Yeah, like it's not nothing. And if you have a small account, could you do this? Like, how much could we make? 287 is our max gain. But, in our trading a smaller account, we consider $150 to be a base hit. If we started with 25,000 and we could make 150 a week, 100 a week, that's pretty good. So if we look at this and we say, well, but we are in this $500,000 account, so we could do 5 contracts. So I'm going to come down and do 5 contracts. Oops, 5. And, then we could make 1,430. Well, if our goal is 2,000, that's putting a good dent in it, isn't it? Now, where would we put our exit? Well, we might say, well, where's a recent, support level? And again, I'm going to just get rid of all these other lines. We're going to shake the Etch-a-Sketch. And when I look at, we had a previous high kind of here, right? And then it came down and kind of retested. It hit it here, broke out. We had this little like double bottom type pattern, right? Came back to retest. So if we looked at this low on this day, 48.88, and we took, said, if we just stick for example purposes, times 0.97, so 47.41. So it would be back in, it would have come back into this range. So if it does that, well, not going in the right direction. And we're paying 49.63. So we're risking just over $2 times 5. Well, that's about $1,000. Even if it gapped down and we got out for less, we still wouldn't hopefully, exceed our, $2,500 risk per trade category. So we're going to say we want this to be at or below 47.41. that's when we're going to throw in the towel. And so, I'm a big fan, and James is also, of knowing when you're getting out before you get in. It's a disciplined approach to trading. And if I can make that decision in the cool, calm light of day, when I'm not feeling emotional, when I haven't been, sipping on hope or fear or FOMO, like these are all 4-letter words in the world of trading. Fear is a liar. We don't tend to make good decisions when we're making a fear-based decision, or often we're making less fantastic decisions, right? So what happened to my first, I thought I'd already put that in, create an opposite order. That's weird. Market, good till canceled. Okay. 47.41. Like, what is this, deja vu? There it is. Save. Okay, confirm and send. So there we go. We're buying 5 covered, which means we're buying 500 shares of Bank of America. We're selling the 5250 call. Oh, I put this order condition not to buy unless. Okay, so we need to delete that. Okay. Dang it. We're going to delete the whole thing because I put it in the wrong place. So we're buying covered stock. So sorry, I made a mistake there. First trigger sequence, opposite order, market. In this, we want this to be 5. Good till canceled. No wonder. I knew I'd put it in. I put it in on the buy order, so then the order wouldn't have filled unless the stock came down and hit our stop, 47.41. Okay. This is why we want to read our orders. And so that's where I was able to catch my mistake. Sometimes it's hard to talk and trade at the same time. And this is why, like, if I'm placing an order in a live account, I will often read it out loud. So I'm buying 500 shares of Bank of America. I'm selling the 5250 call. I want to exit if it goes below 47.41. Okay. So fire in the hole. Oh, well, you know what? I'll put this one in afterwards. And if I get to fill in for James again, we'll follow up on these. But I wanted to show you one last thing as we wrap up. One, if you want to continue to practice these strategies, could you look at a stock like Baker? You could. Looks like we've already done this type of trade in our trading a smaller account. Could we look at an Amazon? We could. Now we have a couple of trades on Amazon, but is a buy right covered call another possible income generating strategy? It's possible. Someone said, well, how about we look at Robinhood? Here's another uptrending stock. It's up 200%. So we're talking momentum here. So could we look at that? We could. Now, these are all examples, but one thing, if you're new to this strategy, I encourage you to subscribe to this channel. It's the Trader Talks channel from Schwab Coaching. And when you first get there, what comes up this is what comes up. What is currently playing? Okay. And, so it's Investing Master Series. If you come to playlists and then come down to the trade management mini sessions, I put a collection of just extra resources together. And I've done all these minis on candlestick patterns, but what I wanted to point out was that I did an example trading plan for buy right covered calls. And you can come and give this a listen and from there create your own trading plan. Okay. And we walk through an example and all of that great stuff. So, we did 3 examples today. We did Oracle, ORCL, we did O'Reilly, and then we did Bank of America, and we looked at Baker and Amazon and a couple of others. So I thank you humoring me today as I filled in for James. Don't tell him, about the flags. But yeah, they'll be coming to a lawn near us soon. And yeah. So if you're looking for an income generating strategy, this might be one that you want to consider adding to your kit bag, depending on your tolerance for risk and depending on your account size and all of that great stuff. So thanks for joining us. Please hit the like button. It helps move this up in the trading, in the YouTube algorithm, so more people can find this content. Please follow Connie and I on X, Barb Armstrong CS, Connie Hill CS, and of course, James Boyd CS, and keep on coming back. I'll be back at, I guess it's 1 o'clock Eastern. 2 o'clock Eastern to talk intro to technical analysis. Take care, everyone. Bye for now.